The broadcast is now starting. All attendees are in listen-only mode.
Hey, good morning, everyone. Doug Mitchell here at Ogletree Financial. Want to thank you for taking your time to be with us today. We got Brett Anderson of IUL Digest that's going to present to us on bear market retirement. And, you know, we've had some scary stuff happen here with us in the last few months, and I think the timing is right to help you guys understand how IUL can really benefit yourself and your clients during times like these, especially if you're getting ready to retire. So if you noticed, we do have a webinar scheduled for June the 3rd, and it's going to be on the best way to design an IUL for maximum accumulation and tax-free retirement income. So make sure you click on the link in the chat box to register for that. Check your email. You'll have an opportunity there. And you'll also get a notification of our YouTube channel that you're going to be able to watch all of the replays on. So we're stocking those up, and you'll be able to see those at your leisure. So enough from me, Brett. I'm going to turn it over to you and let you talk about bear market retirement.
Okay, thank you, Doug. Good morning and afternoon, everybody. Well, as Doug mentioned, I'm Brett. I'm from IUL Digest. I first got started in regard to my knowledge with IUL when I wrote the book Last Chance Retirement. Hard to believe that's like 10, 11 years ago now. I also wrote the only IUL book out there on how to be your own banker. The main thing that I do anymore is that I run IUL Digest, which is the source for current information on the IULs with almost every company there is out there. I'm the only analyst in the industry that ranks all of the IULs from all the companies apples to apples. The current ranking list for May has all 28 primary companies, and there's over 100 IULs on the list. This will just give you a little bit of, background about how I am perceived out there in the industry, I guess you might say. This is the actuary for one of the top IUL companies just this past month. They are in the process of designing their Generation 2 IULs. So he emailed me again and he said, I love your charts. As you pointed out, one crucial aspect of the product is the expense load. Can you send me how much it varies by companies? Appreciate any help that you can provide. So I have since added the 40-year average expense ratio for every IUL onto the ranking chart. This is the chief actuary with another of the top IUL companies in the industry. Thanks for reaching out to me. There's no need to detail your background, as I definitely am aware of the great work you do on educating people about life insurance. You have the best IUL performance comparison and other charts in the industry, and my assistants mention your name and information to me often. You keep us on our toes to remain competitive. That said, I'm still a working agent. I've been in the business for 37 years now, and the one thing that I know is that people want IUL, especially today. I've spoken with several companies in the last month or so, and they all tell me that they have record numbers of applications for life insurance and IUL since this pandemic started. All you need to do is to show them the concept and a good product. New knowledge is the most valuable commodity on earth. The more truth we have to work with, the richer we become. IUL is becoming even more popular because the returns can be linked to the S&P 500 or other index. You are not in the stock market. This means you get to keep all the credited annual gains. I don't know about you, but I had several clients email me when we had the market crash a few weeks ago, thanking me for having put them into an IUL so that all of their monies were still there. But we need to hold on here for a second. Even the best IUL with the best company can be a mediocre to bad plan if it's designed poorly. 99% of agents have no idea what the best way is to design IUL, or even who the top companies are. The reality is, most of the time, the company and design presented is the worst company and poorest policy performance design. Typical IUL design The client and the agent thinks they want maximum life insurance benefit, minimum premium, limited pay, lowest cost, term insurance. Well, the best way to design an IUL is the opposite of what your client and you think it should be. But knowing how to design an IUL is just the beginning. There's not enough time to go into that today, but beware of IULs with illustrations of high returns that are run with a non-guaranteed multiplier and/or bonus and/or participation rate. One popular company has a 155% participation rate, but the guaranteed is only 5%. Another has a 54% multiplier, but the guarantee is only 0%. If IULs are ranked on the basis of the minimum guaranteed multiplier, participation rate, and bonus, the companies on the top of the performance chart fall to the bottom. There are good performing IULs that have the illustrated multiplier and bonus and participation rate guaranteed. The back-tested 40-year internal rate of return since 1945 for one of them is 9.33%. Your clients and you will sleep much better at night in the decades ahead if you understand all the moving parts and select an IUL where the illustration you are showing them is more real. So like Doug mentioned, we're going to do a best design webinar on June the 3rd. For now, just know that the company, loan features, and other options matter, especially for bear market retirement. This is your client's greatest risk in retirement, and they have never heard anything about it. Aha! The agents who get this and who show their prospects bear market retirement risk will have a unique niche in the retirement income IUL market and do their clients a great service and make a fortune for themselves. So, what if the first 2 years of retirement have a 0% gain, or what's called retirement day bear market risk? I've been talking about this since 2016. In 2018, companies started calling it sequence of returns. It doesn't matter when the income sequence is, a bear market anytime in retirement can have the same calamitous result. Also, most people have small retirement savings, such that a sequence provides very little strategy or income. So in reality, most of them need to keep most of their savings in stock funds to try to maintain the cash wealth they do have. But what does everyone do with their investments on the day they retire? They put them in assets with no or very little market risk. Why? Because they can't afford to lose any of it. There are 2 times when a man shouldn't speculate, when he can't afford it and when he can. Mark Twain. Just after I wrote a report about this, Forbes was kind enough to write about it too. The title of their article is Navigating One of the Greatest Risks of Retirement Income Planning. The financial market returns experienced in retirement matter a great deal more than most people realize. Even with the same average returns over a long period of time, retiring at the start of a bear market is very dangerous. Wealth can be rapidly depleted as withdrawals are made from a diminishing portfolio, leaving little money to benefit from a subsequent market recovery. The average market return over a 30-year period could be quite generous, but if negative returns are experienced when you start spending from your portfolio, you will face an insurmountable hurdle that cannot be overcome, even if the market offers higher returns later in retirement. Poor early returns followed by strong later returns will still derail a retirement plan. With a 50-50 portfolio for each of the 61 rolling historical 30-year periods since 1926, historical outcomes vary greatly. In some cases, remaining wealth is entirely depleted within the first 15 years of retirement, at the beginning of the bear market. So what about bear markets? These are a few of the big ones we've had since 1970. The one that we had in March of this year, between the March 4th and March 23rd, was a drop of 28.5%. Since World War II, they occur every 6.14 years. The market falls on average 33%. It takes 1.33 years to hit the bottom. The average monthly loss is just over 2%. It takes almost 2 years to recover. The result is that on average, 3 out of every 6 years is a 0% net gain. So what about bear market rallies? Since the low on March the 23rd, the S&P is up 25% as of last Friday. So the year-to-date net drop is only a minus 10.5%. Well, this is Forbes from May the 13th, lessons from the past. Bear market rallies create a false sense of security. Although bear market rallies can tempt investors, when you consider what lies ahead, there will be considerably more turmoil in the global financial markets. The worst is yet to come. Therefore, the probability of further declines in stocks is high, and it's best to be cautious and avoid large losses. This is Market Watch from a couple weeks ago. Don't be fooled. A 40% drop could hit by next year after this bear market rally fades, warns a veteran economist. So what about the future? Unfortunately, none of us have a crystal ball to know if it's going to keep getting better or if what those experts have seen from the past is what's going to prevail here over the short term. The only thing that we do know for certain is that the market can stay irrational longer than you can stay solvent. Very famous economist. 2020 was the 11th year of a bull market, and then a bug from halfway around the world crashed it almost overnight. What and when will it be next time? Do you remember 12 years ago and 18 and 23 years ago and very possibly 5, 10, and 20 years from now? This is what everyone was and will be saying. In regard to the stock market, we're all going to die. This makes the year before and a couple years after retirement the most dangerous and fearful for most people, if they have stocks, not if they have an IUL. If it is with the right company and designed the best way. Here's the example that I'm going to use for this. I have a male 50 non-smoker preferred, minimum insurance, option B. Premium is $12,000 a year for 20 years. Oops. This is based on the S&P average gains for the prior 20 years, and for this period I'm using 1999 to 2018. The IUL gain accumulation years 1 to 20 with a 10% multiplier and a no cap with a 3% spread, which is a good long-term average. And the gains in income loan years 21 plus based on the average gain works out to be about 10.11% gross. So years 1 and 2 in retirement have a 0% gain, except they are credited with a 1% a year bonus. This starts in year 11. The loss gains of 10.11% a year are recaptured over the next 4 years at 14.67%. You'll see it on the chart. The gains are going to be linear. There's no other ups and downs. I'm using a variable loan rate at 6%, which in the case for this particular company is the cap. And the loans are going to be $25,000 a year for years 21 to 40. So based upon just what the market actually did and what the IUL is credited with, you can see that the average credited gain over this 20-year period was the 10.11%, which resulted in a net gross account value of $557,000 or 7.48%. Now, the 20-year average net internal rate of return since 1945, based upon the current 6.5% spread, not the 3% in this example, is 7.4% versus the 7.44% for this 20-year period example. So what you are seeing in real numbers for what I'm showing you is a pretty dang close to what the average IUL performance has been since 1945. for 20-year periods. So for years 21 to 40, we use that 10.11% gross gain for each year, and we end up with an account value in year 40 of $2,695,000, or 9.33% average rate of return over the 40-year period. So the 40-year projected average is 1945. That's 55 20-year periods, or 220 quarterly years. For the 6.5% spread also works out to be 9.33%. And this includes 22 bear markets since 1946. So this is a perfect example of the long-term average. With a more real average spread in the 3% range, the IUL benefit would be even greater. So here's years 21 and 22, where we have the 0% gain in the first 2 years, except that the company has the 1% bonus. So they get that at least for the first 2 years. So we're going to recapture what they didn't earn in those 2 years over the next 4 years at 14.67%, so that over the whole 20-year period, we still end up with the same 10.11% average. And our account value, net the loans, is going to be $2,648,000, or an internal rate of return of 9.29%. So what about the S&P 500? For the 15 years ending in June 2018, the S&P outperformed 92% of U.S. large cap stock mutual funds. So it's a good model for how the overall market actually performs. At the end of December 2018, 401k plans held $5.2 trillion in assets and represented 19% of all the money in retirement assets. 64% of 401k plan assets were held in stock mutual funds. $19 trillion in total U.S. mutual funds. As of 6/30 of 18, 55% of this is in stock funds. So the end of December 2018, 31% of all stock mutual funds are in 401k's qualified plans. Well, how about performance? And this is the Dalbar report. It comes out every year to show what the average investor actually earned in the market. Over the past 20 years, from 97 through 2017, the S&P 500 returned 7.2%. Over the same time period, the average dollar invested in U.S. equity mutual funds returned 5.29%. Majority of that gap is explained by bad buy and sell decisions, and fund expenses also explain another significant part. This is pretty much the number that they come up with every year when they come out with the report on what the average investor actually earned over a 20-year period, and it always comes in around the 5% mark. Here's the report, March 2019. Average investor blown away by market turmoil in 2018. The average equity fund investor lost twice the money of the S&P in 2018. The average investor was a net withdrawer of funds in 2018, but poor timing caused a loss of 9.42% on the year, compared to an S&P 500 index that retreated only 4.38%. In 2018, the average investor underperformed the S&P in both good times and bad, because investors just for some reason will just not sit on their hands and just leave their money alone when they see the market is falling short term. Don't try to buy at the bottom and sell at the top. It can't be done except by liars. And Warren Buffett, much success can be attributed to inactivity. Most investors cannot resist the temptation to constantly buy and sell. We don't get paid for activity, just for being right. As to how long we'll wait, indefinitely. So what do these qualified plans cost? According to a study in August 2016, this is sourced from the ERISA 408B2B disclosures filed with the federal government. For 121 401k plans with less than $2 million in assets, the average all-in fees came to about 2.22%. Now this shows what would have happened with your returns in the market if you'd missed X amount of days. So if you were in all of the days for this 20-year period, you would have had an annualized return of 7.2% in the S&P. If you missed just the 5 biggest days in that 20-year period, your total return would have dropped to 5.02%. So the impact of missing just those 5 days was a 45% drop in the account value. You missed the 10 biggest days and the annualized return dropped to 3.53%. So now you've lost 67% of what you could have earned just by missing the 10 best days. If you missed the 40 best days, then you had a loss of minus 2.8%. Your impact of missing those 40 days was a minus 114% in your account value. The investor chief problem, and even his worst enemy, is likely to be himself. So, another big advantage of IUL is that you have to leave the money in. So what about the actual S&P 1999 to 2008? The gains were 7.82% a year, including the dividends. This represents a typical stock mutual fund. The total annual costs were 2.22%. The fund takes withdrawals instead of loans to provide income. So for our loss years, 21 and 22, the average loss in the previous 20 years was 17.72% when there was a loss, plus the costs. So to make up for that, in years 23 to 26, we're going to have a 20.59% average gain. So here's what the market actually did those years. And over on the right in the blue column, it says segment values. So the gains in the actual S&P, any stock fund, works differently than it does for an IUL, because all that matters is what the price of it was at the beginning and the end, not what happens in between. So what I've had to do is determine what the value would be for each segment. So for 1999, that's how it would have performed from 99 to 2018. The next one is from 2000 to 2018, and you add up all the values, and so it would have been worth $400,000, or a 5.95% average rate of return plus the dividend. So the average is 7.82%. So we're going to use that for the next 20 years. We're going to take our $25,000 withdrawal, less our 2.22% in costs, and our value at the end of 40 years is $240,000, a 5% rate of return, just like the average for Dalbar keeps coming up with all the time. So here's where the bear market hits for those who are in the market, and we have a 0% gain in the first 2 years, and actually in this case, we've got almost an 18% loss in each of the first 2 years. Then we make it up the next 4 years with that 20.59% for 4 years, then back to our 7.82, then our overall average is the 7.82%. Well, our account value has dropped down to $38,000, or a 4% net rate of return. So here's the summary. In year 20, the IUL was worth $557,000. The S&P was worth $400,000. Years 21 to 40, with our $25,000 annual loan or withdrawal, with no market loss, no bear market, the IUL was going to be worth $2,695,000. The S&P was only going to be worth $240,000. So that's just what we were just looking at. So here we are with the bear market in the first 2 years of retirement, in this case, years 21 and 22. You can see that the IUL value has only gone down 1.72%. It's still worth $2,648,000. The S&P value has dropped from $240,000 to $38,000. It's dropped 84% in value, and there wasn't that much to begin with. So with the IUL, there is no bear market risk. That S&P account will be broke in 2 more years. This is based on the same S&P historical gains in retirement income. So my question to you is, why even save in funds or qualified plans? I mean, really, why? especially when we all know that with all the money the federal government is having to spend today for the pandemic, that the only direction that tax rates can go up in the future is up. So why defer a debt when doing so will only make it get bigger and on more money as it grows? Rule number 1, never lose money. Rule number 2, never forget rule number 1. If I was shown this report, I would never save a dime in funds or qualified plans. I don't have any. And don't forget that most people at retirement will not keep any of their savings in stocks. That means if today, a few weeks ago anyway, they will be earning only 1 to 2% on their money. So they will have to take much less income and or the account will go broke much quicker if they don't. So a big advantage of IUL is that they can keep earning market gains in retirement with no market risk. There is no security on this earth, there is only opportunity. For your clients, retirement cash value and income, how it is designed matters. Which company it is with matters. So how can you know who the best companies are? Well, talk with Doug. And that's what I do.